On the surface, Monday, April 27th, 2026 looks like a footnote in the history of global finance. If you were to glance at a terminal or a standard trading app, you would see a market caught in the quiet, rhythmic breathing of consolidation. Silver is sitting at 74.76, gold is resting at 4,175.80, and both metals are flickering slightly in the red. To the casual observer, this is a slow news day, a moment of rest in a volatile year. But for those who understand the structural architecture of the global commodities market, the silence is deceptive. It is the pressurized, heavy silence that precedes a tectonic shift. Beneath the daily chart noise, a structural situation is building inside the futures market that is exactly 4 days away from its most critical stress test since this bull market began. The outcome of this test will do one of two things. It will either confirm that the current price suppression mechanism can survive for another 60 days, or it will expose a supply reality that has been quietly hollowed out for the better part of 6 months. The window for calm analysis is closing. By the time Friday morning arrives, the data will have already made its choice. We are currently standing at a convergence point where the physics of supply is finally colliding with the mathematics of debt. If you are holding physical silver, or if you have been watching this market from the sidelines, you need to understand that the next 4 days will likely matter more than the last 4 months combined. This is not about a minor price fluctuation or a technical correction. This is about the credibility of the primary exchange that sets the price of silver for the entire world. July is not just another month on the calendar, it is a point of impact. To understand the magnitude of what is at stake, we must look past the price on the screen and focus on a single devastating number, 135 million. That is the current open interest in the May silver contract on the COMEX. It represents approximately 26,963 contracts, with each individual contract serving as a legal claim to 5,000 troy ounces of silver. If every one of those contract holders decided to stand for delivery, to demand the physical metal they have technically purchased, the exchange would be legally obligated to produce 135 million ounces of silver. Now look at the number sitting across the table from that obligation, 77 million. That is the total amount of registered silver currently sitting in COMEX vaults, the metal that is officially verified, vaulted, and designated as available for delivery. This is not an estimate. It is not eligible silver that might be for sale. It is the final line of defense. The gap between 135 million ounces of paper claims and 77 million ounces of physical supply is no longer a technicality. It is a structural deficit. In any other industry, this would be called a run on the bank. In the world of precious metals, it is the beginning of a breakdown in price discovery. Consider the metaphor of financial plumbing. Most investors spend their time looking at the faucet, the price, waiting to see if the water flows faster or slower. But we are currently in the basement looking at a set of pipes that have been vibrating under extreme pressure for months. Since October of last year, the registered silver inventory has collapsed by 50%, falling from 157 million ounces to the 77 million we see tonight. The eligible buffer, the secondary layer of supply, has dropped by over 100 million ounces in that same window. Both lines are trending down with an unmistakable aggressive trajectory. The market is screaming that production is no longer keeping pace with consumption and that withdrawals are far outstripping deposits. The exchange is being drained in real time, yet the paper obligations remains enormous. This brings us to the core mystery. How does a system with twice as many claims as it has assets continue to function? The answer lies in the mechanics of the roll. Normally, institutional traders don't want the actual metal. They want the price exposure, so they roll their contracts forward to the next month. But what happens when the holders stop rolling? What happens when they realize that the vault is half empty and the exit door is narrowing? Thursday, April 30th, is first notice day. It is the moment when the bluff is called. It is the date when any contract holder intending to take physical delivery must formally declare their intent. For the COMEX to navigate the month of May without a structural failure, the arithmetic is unforgiving. Fewer than 15,000 contracts can stand for delivery. If 15,001 contracts demand their silver, the registered vault is effectively gone. The open interest is not declining fast enough to meet this threshold through normal market behavior. This suggests we are approaching a moment of forced resolution. In the past, we have seen technical outages and server failures during this exact critical window, convenient glitches that allow for quiet, behind-the-scenes negotiations and cash settlements to prevent a physical default. But as we head into May 2026, the global context has changed. We are no longer dealing with a localized squeeze. We are witnessing a synchronized convergence of 7 distinct signals, from White House directives on price floors to Chinese export bans on critical processing inputs. The question isn't whether the authorities can manage the month of May. The question is what is left of the system once they do. We are watching the final stages of a transition from a market governed by paper derivatives to a market governed by physical scarcity. If the COMEX is forced into another stealth force majeure, the price may be managed sideways in the short term, but the underlying inventory will take another devastating hit. By July, the concept of a benchmark price set in New York may become structurally indefensible. As we move toward Thursday's deadline, the stakes are not merely financial, they are geopolitical. We are staring at a deadline that was set months ago by different actors in different rooms, all landing in the same 30-day window. The plumbing is failing, the vault is draining, and the clock is ticking. In this essay, we will deconstruct the mechanics of this collapse, the hidden policy decisions moving behind the scenes, and why the great repricing is no longer a matter of if, but a matter of when. The window for the background conversation is closing. It is time to look at the data. To understand why the current state of the silver market is so precarious, we have to look beyond the immediate panic of the next 4 days and examine the architectural decay that has been hollowing out the system for years. The COMEX, or the Commodity Exchange, is not just a collection of vaults in New York, it is the central nervous system of global price discovery. For decades, it has operated on a foundational assumption that the massive mountain of paper contracts, the digital promises to deliver metal, would never actually be challenged by a collective demand for the physical reality. It is a system built on the mirage of liquidity, where the sheer volume of trading creates the illusion of an infinite supply. But history shows us that when the physical supply begins to evaporate, the mirage doesn't just fade, it shatters. The current inventory collapse is not a seasonal fluctuation, it is a structural hemorrhage. To grasp the severity, one must understand the two-tiered hierarchy of the COMEX vaults. First, there is eligible silver. This is metal that meets the exchange's strict requirements for fineness and weight and is stored in approved vaults, but it is owned by private entities, hedge funds, family offices, or institutional stackers. It is not for sale at the current screen price. It is simply being parked. Then there is registered silver. This is the ready cash of the exchange. This is the metal that has been officially designated by its owners to be available for delivery to satisfy a futures contract. In October of last year, the registered vault held 157 million ounces. Tonight, that number has shriveled to 77 million. That is a 50% collapse in the world's primary liquidity buffer in just 6 months. But the truly alarming signal isn't just the registered drain, it is the simultaneous disappearance of the eligible silver. In that same 6-month window, over 100 million ounces of eligible silver have been removed from the system entirely. This isn't just metal moving from one category to another. This is metal being loaded onto trucks and ships, leaving the exchange's ecosystem altogether. When the smart money begins to withdraw its physical holdings from the vaulting system, it is a vote of no confidence in the exchange's long-term stability. They are moving from custodial trust to private possession. And that shift is a leading indicator of a system nearing its breaking point. This situation bears a haunting resemblance to the collapse of the London gold pool in the late 1960s. At that time, the world's major central banks attempted to peg the price of gold at $35 an ounce by aggressively selling their physical reserves whenever the market price threatened to rise. For years, the mechanism worked. The paper peg held because the physical vaults were deep. But eventually, the market realized that the pool was draining faster than it could be replenished. Investors and sovereign actors began to demand the physical metal in such volumes that the authorities could no longer maintain the illusion. In March 1968, the pool collapsed. The market was closed for 2 weeks, and when it reopened, the price was no longer set by a committee of bankers, but by the undeniable reality of scarcity. We are currently watching the silver version of the London gold pool play out in real time. The paper-to-physical ratio, the number of digital ounces traded for every 1 ounce that actually exists in the vault, has reached a level that defies the laws of financial gravity. In a healthy market, the futures exchange acts as a price discovery mechanism for the physical commodity. In a broken market, the futures exchange becomes a price suppression mechanism that eventually loses contact with the physical reality. When the gap between the paper price and the cost to actually acquire physical metal becomes too wide, the system undergoes a basis explosion. We are seeing the first cracks of that explosion tonight, as institutional buyers begin to bypass the COMEX entirely, paying premiums of $5 to $10 over the spot price just to ensure they can actually secure the metal. Why is this happening now? For years, the silver market was balanced by a steady flow of byproduct production from copper and lead mines. But as global industrial demand has accelerated, driven by a relentless shift toward electrification and renewable energy, that steady flow has turned into a deficit. We are no longer living in an era of surplus. We are living in an era of just-in-time delivery for a metal that requires just-in-case stockpiling. The 77 million ounces remaining in the registered vault represent less than a few weeks of global industrial demand. If the COMEX were a commercial bank, its reserve ratio would be considered catastrophically low. Imagine a bank that has 135 depositors each, holding a claim for $1,000, but the vault only contains $770 in cash. As long as those depositors are content to trade their digital balances back and forth, the bank survives. But the moment those depositors look at the news, see the vault is draining, and decide they want their cash in hand, the bank ceases to be a functional institution. This is the deep context of the May 2026 delivery cycle. It is not just about a few thousand traders wanting silver. It is about the realization that the primary global exchange has allowed its physical foundation to erode to the point of insolvency. The trajectory is unmistakable. Both the registered and eligible lines are trending down hard and continuously. There are no offsetting inflows on the horizon. The production stats are stagnant, the mining costs are rising, and the sovereign buyers, led by China, are vacuuming up every available ounce. The historical parallels tell us that these situations do not resolve through a slow, orderly return to normalcy. They resolve through a violent revaluation. The deep context of this crisis is that the world is rediscovering the difference between a price and a value. A price is what you see on a screen. Value is what you have in your hand when the screen goes black. As we move toward the mechanics of the May contract in the next section, keep that distinction in mind. The vault isn't just draining. The very concept of the paper price is losing its grip on the physical world. To understand the gravity of the next 96 hours, we have to look past the rhetoric and perform a cold, clinical autopsy on the mathematics of the COMEX itself. In the world of high-stakes commodities, the meat of the story is always found in the friction between contractual obligation and physical reality. As of tonight, that friction has reached a heat level that the system's cooling mechanisms were never designed to handle. The primary engine of this crisis is the May silver contract. As of this recording, the open interest stands at a staggering 135 million ounces, represented by 26,963 individual contracts. Each of these is a legally binding agreement that, upon expiration, grants the holder the right to demand 5,000 troy ounces of physical silver. Standing directly across from this mountain of paper is a vault containing just 77 million ounces of registered silver. This is the registered category, the only metal officially cleared for delivery. The math is as simple as it is devastating. The claims outnumber the available supply by nearly 2 to 1. Thursday, April 30th, is first notice day. In the mechanics of the futures market, this is the moment of truth. It is the deadline by which any contract holder who intends to take physical delivery must formally declare their position. For the COMEX to survive the month of May without a total structural failure, the longest of the buyers must be persuaded to walk away. Specifically, the arithmetic dictates that no more than 15,000 contracts can stand for delivery. At 5,000 ounces per contract, 15,000 contracts equals 75 million ounces, effectively 97% of the entire registered vault. If 15,000 contracts demand their metal, the vault is, quite literally, empty. But markets of this scale rarely fail in the way a local business might. Instead, they glitch. If we look at the data from December 2025 and February 2026, a highly specific and suspicious pattern emerges. In both delivery cycles, as the open interest remained stubbornly high heading into the final 48 hours, the COMEX servers went offline. The stated reason was technical difficulties, but the timing was surgical, landing on the Monday and Tuesday of the critical week. This downtime creates a strategic vacuum, a dark window, where transparent trading stops and institutional arm twisting begins. During these outages, the exchange moves from a public marketplace to a private negotiation room. Using a combination of cash premiums, institutional pressure, and what is effectively a stealth force majeure, contract holders are convinced to roll their positions forward into future months or settle for cash rather than demanding the physical metal. It is a tactical reset designed to prevent the registered vault from dropping below a survivable threshold. Tonight, as we approach the same Monday-Tuesday window for the May contract, the probability of a third technical infrastructure problem is not just high, it is the only move left on the board. However, the effectiveness of this server outage playbook is being undermined by a new, more dangerous variable, the fragmentation of the market. While the COMEX attempts to manage the paper price at $74.76, the physical world has already begun to move on. We are currently witnessing a two-price market. Across the mining sector, a rebellion is brewing. Major silver producers are no longer satisfied with the screen price dictated by New York. In the first quarter of 2026, several large miners reported realized silver prices that were $5 to $10 per ounce above the official COMEX spot price. This isn't happening in the retail market, it's happening at the institutional level. Sovereign wealth funds and massive industrial consumers are realizing that the COMEX supply chain is no longer reliable. Instead of going through the exchange and risking a cash settlement, they're going directly to the mines, bypassing the middleman, and paying a premium for guaranteed physical delivery. When the entities who actually need the metal stop trusting the exchange to provide it, the exchange loses its status as a global benchmark. It becomes a closed loop of paper traders, while the real metal moves through shadow channels. The pressure on this broken system will intensify on May 5th, when the major silver producers begin releasing their first quarter earnings. Because the average price of silver and gold in Q1 2026 was the highest in recorded history, these reports will reveal massive margin expansions. Revenue per ounce has surged by nearly 50% year over year, while operating costs have remained relatively stable. More importantly, these earnings will publicly confirm the premium reality, showing the world exactly how much sovereign buyers are paying above the COMEX price. This creates a feedback loop. As the gap between the paper price and the realized price becomes public knowledge, more contract holders will demand delivery, further draining the vault and forcing the exchange into even more desperate technical interventions. Finally, we must account for the byproduct squeeze. Approximately 25% of the world's silver is mined as a byproduct of copper production. On May 1st, China, the world's dominant processor of copper ore, will implement a ban on the export of sulfuric acid, a critical chemical input for copper refining. By restricting sulfuric acid, China is effectively throttling the global production of copper, and by extension, silver. This creates a supply floor that cannot be engineered away by paper contracts. We are watching a collision between a digital illusion and a chemical reality. The COMEX is attempting to maintain a price ceiling using server outages and cash settlements, while the physical supply is being pulled away by sovereign actors and restricted by geopolitical maneuvers. The mechanics are clear. The exchange is running a game of musical chairs where half the chairs have already been removed from the room. By Thursday, the music stops. Whether the COMEX finds a way to keep the game going or the floor finally gives way, the data tells us one thing with certainty. The current price is a fiction that the vault can no longer afford to support. As the internal mechanics of the COMEX grind toward a potential standstill, the shockwaves are already radiating far beyond the vault walls of New York. This is no longer a localized dispute between paper traders and vault managers. We are witnessing a fundamental shift in the geopolitical gravity of the precious metals market, a great uncoupling, where the power to dictate the value of the world's most essential industrial metal is moving from the west to the east. To understand the ripple effect, we must first look at the silent accumulation occurring in Shanghai. In March 2026, China imported 27 million ounces of silver in a single 30-day window. This is the largest monthly import in the recorded history of the Chinese market. As a direct result, the combined silver inventory held across the Shanghai Gold Exchange and the Shanghai Futures Exchange has swollen to 36 million ounces. On the surface, that number seems smaller than the COMEX's 77 million. But the trajectory is what matters. While the Western Vault is hemorrhaging 50% of its lifeblood in 6 months, the Eastern Vault is being fortified with record-breaking intensity. If the May delivery cycle draws down the expected 50 million ounces from the COMEX, we will reach a historical inflection point. The United States primary commodity exchange will hold less physical silver than China's national exchange infrastructure. This is a geopolitical earthquake. The COMEX's status as the global benchmark for silver is not an inherent right. It is a function of physical credibility. When the world realizes that the price is being set by an exchange with an empty vault, while the metal is sitting in an exchange with a surplus, the benchmark follows the metal. China isn't just buying silver, they are buying the right to set the price. This shift is being accelerated by what we can call the sulfuric acid kill switch. Starting May 1st, China is restricting the export of sulfuric acid, a primary processing input for copper refining. Because a quarter of the world's silver is a byproduct of copper mining, this move effectively places a chokehold on global silver supply at the exact moment Western inventories are at a 6-year floor. This is statecraft disguised as trade policy. By restricting the chemical inputs needed to refine silver in the West, China is ensuring that the physical scarcity remains acute, forcing the COMEX into a corner where it must either revalue or default. While China plays offense, the United States has begun to play a desperate, quiet defense. On January 14, 2026, the White House issued a formal trade proclamation that has gone largely ignored by the mainstream financial press. Inside this document is a directive requiring the Secretary of the Treasury to investigate price floors and other trade-restricting measures for critical minerals. Silver is on that list. The deadline for the formal update to the President is July 13th, exactly 180 days from the proclamation. This is the government acknowledging what the market has known for months. The paper price discovery mechanism is broken. A government-mandated price floor is the ultimate admission of scarcity. It is a border-adjusted shield designed to protect domestic industry by essentially fixing a minimum price for silver that is likely far higher than the current COMEX screen price. This explains why United States trade ambassadors have been deployed across the UK, EU, Japan, South Korea, Mexico, and Canada in the last 3 days. They aren't just discussing trade, they are coordinating a global repricing of the physical assets that underpin the modern world. The winners in this new reality are clear. The sovereign wealth funds and physical stackers who secured their positions before the exit narrowed. We are seeing sovereign funds bypass the exchange system entirely, going directly to the miners to pay $10 premiums. They have realized that in a world of $40 trillion in debt and $1.3 trillion in annual interest payments, the dollar is a currency of trust, while silver is a currency of reality. The losers, conversely, are the institutions still holding massive short positions on the COMEX, entities that have spent years betting that the paper mirage would never end. They are now trapped in a room with no doors, facing a delivery demand they cannot satisfy, and a government that is preparing to move the goalposts through price floors. The most profound ripple effect, however, is found in the industrial sector. Silver is not a luxury. It is the indispensable metal of the energy transition. A single residential solar installation requires 20 grams of silver. As energy costs soar, the demand for solar panels has become price insensitive. If the price of silver doubles, the cost of a solar panel increases only marginally, but the alternative, a tripled electricity bill, is unacceptable. This creates a demand vacuum, where industrial buyers will pay almost any price to secure the metal they need to survive. This is the geopolitical checkmate. We have price-insensitive industrial demand colliding with state-sponsored supply restrictions, all set against a backdrop of a Western exchange that is running out of physical inventory. The ripple effects of the next 4 days will likely redefine the value of the West. If the COMEX fails to deliver, or if it resorts to a third consecutive server outage to mask its insolvency, the world will stop looking to New York for the price of reality. They will look to the vaults that actually have the metal. The geopolitical shift isn't coming. It is already in the water. We are simply waiting for the tide to go out and show us who has been swimming naked. July 2026 is the horizon line where these forces converge. Between the White House deadline, the Chinese export bans, and the COMEX's internal math, the global financial system is preparing for a hard reset. The era of cheap, paper-suppressed silver is ending. The era of the physical premium has begun. In the final part of this essay, we will examine the ultimate verdict. What this means for the future of the dollar, the $40 trillion debt trap, and the philosophical reality of wealth in a post-paper world. As we reach the conclusion of this analysis, we must stop looking at the daily fluctuations of the COMEX and start looking at the arithmetic of survival. The convergence we are witnessing is not a series of unfortunate events. It is a mathematical inevitability. Every thread we have pulled, from the draining vaults in New York to the strategic hoarding in Shanghai, from the White House's July 13th deadline to the surge in $20,000 gold options, leads back to one inescapable reality. The current monetary system has run out of room. The Godzilla in the room is the $40 trillion United States national debt. At an average interest rate of approximately 4%, the annual interest expense has already reached $1.3 trillion. To put that into perspective, interest payments are now consuming more than a quarter of all federal tax receipts before a single soldier is paid or a single road is paved. If interest rates were to climb to 12%, a level historically common during periods of high inflation, the interest expense would hit $5 trillion. That is 100% of the federal government's total tax revenue. This is the mathematical ceiling. Beyond this point, the system is no longer just stressed. It is arithmetically insolvent. This trapdoor means the Federal Reserve has only one viable path forward: rate reduction and dollar debasement. But you cannot debase a currency that is the world's reserve without triggering a global repricing of the things that currency buys. Silver at $74.76 is a price set against a backdrop of a stable dollar. In a world of a $40 trillion debt load, that stability is a ghost. The massive accumulation of out-of-the-money gold calls at $10,000, $15,000, and $20,000 strike prices isn't volatility trading. It is a massive directional bet on a policy decision that specific market participants believe is imminent. It is a bet on a revaluation. We have seen this playbook before. In 1934, Franklin Roosevelt revalued gold to retire debt at the trough of the Depression. In 1971 and 1973, Richard Nixon did it again to manage the collapse of Bretton Woods. Both times, the official price was set, the balance sheet was cleared, and the market immediately bid the price even higher. Today, the United States government carries its gold on the balance sheet at a book value of just $42 per ounce. On the open market, it is trading near $4,700. That gap represents the single largest unrealized asset on the planet. By formally revaluing that gold to $5,000 or $10,000, the Treasury could generate trillions in capacity without issuing a single new bond or adding a dollar to the national debt. Silver is the primary beneficiary of this monetary magic trick. Because silver is both a monetary metal and an indispensable industrial input, it gets pulled by two separate powerful forces. As the dollar is devalued to save the Treasury, the monetary demand for silver explodes. Simultaneously, as the global energy crisis forces a price-insensitive transition to solar and electric vehicles, the industrial demand for silver reaches a fever pitch. You can print $1 trillion with a keystroke, but you cannot print a single ounce of silver. You cannot build a solar panel with a digital promise. This is why the July 2026 window is so critical. The 180-day White House deadline on July 13th, the USMCA trade review on July 1st, and the looming insolvency of the COMEX vault are all landing in the same 30-day window. It is the point of impact. If the COMEX executes another stealth force majeure or cash settlement, it is not a sign of the exchange's strength. It is the starting gun for the repricing. A cash settlement is simply an admission that the metal is gone. It is the moment the paper ghost finally separates from the physical bone. When the repricing arrives, and Bank of America's forecast of $300 silver suggests the scale of what is coming, it will likely be presented as an orderly policy response. It will be framed as protecting critical mineral supply chains, or stabilizing domestic industry. But for the individual holding the physical metal, the name doesn't matter. What matters is that they are on the right side of the divide. We are moving from an era of digital abundance, where everything felt cheap because the debt was hidden, to an era of physical scarcity, where the world's most essential assets finally demand their true value. The final verdict is this: the COMEX is not breaking. It is being relaunched at a new reality. The global economy is not collapsing. It is being repriced to account for 40 trillion reasons why the old system can no longer continue. The silver insurgency we are witnessing is the market's way of correcting a decades-long imbalance. Scarcity is not approaching. It is already here, hidden behind server outages and technical delays. In the coming weeks, as we pass the April 30th deadline and head into the mining earnings of May, the gap between the screen price and the real world will become impossible to ignore. The window for calm analysis is almost closed. Soon, the conversation will no longer be about if silver will reprice, but about who was prepared when it did. The choice between holding a digital promise or a physical reality is the most important financial decision of this decade. History teaches us that during structural transitions, the majority of participants wait for permission to believe the change is real. They wait for the official announcement, the first notice, or the evening news. But in the world of high-level geopolitics, the announcement is the final step, not the first. The data has already spoken. The vaults are draining, the deadlines are set, the arithmetic is final. Until the next update, stay physical, stay informed, and stay positioned. Because when the great repricing executes, the only thing that will matter is what you have in your hand when the music stops. The world is about to find out just how much a real ounce of silver is worth. Do you?